Greetings. Welcome to my weekend market recap, 4th December 2021. I am Sagar Nandi, retired IT professional swing trading stocks using the Q systems and techniques that I developed. These are my email IDs, my website, YouTube channel, and Twitter handle. I regularly share live market and stock analysis through these channels. Disclaimer: this demonstration is for educational purposes only. I am not an investment advisor. It is not a trade recommendation. Trading involves risk. You and only you are solely responsible for the outcome of your trades. I may mention about options trading from time to time. You may refer to the characteristics and risks of standardized options document from Options Clearing Corporation to decide if option trading is suitable for you. I use the Q systems in my trading. They run as add-ons to the Metastock and TradeStation platforms. That was the last slide. Let's continue with a look at the global market, starting with the Australian index, all ordinaries. All ordinaries came to the weekly trendline support and closed with an indecisive shaped candle with indecision signal. Because the weekly is indecisive, we wouldn't take any trade in all ordinaries right now. Also in the daily, if we look back, you will remember that when all ordinaries was here, I suggested taking a short trade, which would be a short trade at the upper edge of a sidewise range using short call vertical. As price came down to this area, I suggested closing the trade because more than risk resistance was covered. At that time, I also suggested not taking any short trade because it was near the lower edge. We could take a long trade if price went up, which it did not. What to do now? Even if price goes up now, it will be very close to the next trend line resistances. So we will not try any long trade even if price goes up, and if price comes down, the breakout trade may not give a low risk shorting opportunity. We may wait for a recovery and then for price to tilt down again, giving us a low risk, which will be a go with flow short trade setup. At present, for swing trading purposes, it is moving inside a range and we don't have any trade setup. Now in the tweet announcing this webinar's time and link, I mentioned that at the current price level, I am not so bearish. Not that I am bullish, but I am not so bearish, and I may start to look for strong buy candidates. Why did I say that? I will explain as I go along. While looking at the global markets, one question that I was trying to ask myself that am I going to short at this point? Whether buying or not is a separate thing. Am I going to short? And the answer to that question in the Australian market, as I explained just now, is that no, I am not going to short now. For Australian index, I am not going to buy also, but it is true that I am not going to short as well. Let's see what is the answer to that question for the other global markets. Am I going to short now or not? Let's look at Japanese market, Topix index. topics index is right at weekly trend line support, and it displayed a bullish indecision at the bottom. In the daily also, it is at trend line support and at watermark support at the lower edge of a sideways range, and it has displayed a cluster of indecision at the bottom, bullish signal, and then a bull release signal as well with bullish pressure. So if I ask the question, am I going to short topics now? The answer will be a clear no. If anything, like I explained in case of All Ordinaries of Australia, if price went up, I would look for long in All Ordinaries, except that there was trend line resistance. In topics, it has actually gone up from the lower edge of a sideways range from trend line support as well, and next trend line support or resistance, rather next trend line resistance is far away. So if anything, I would look for a buy setup at Friday's close. So the answer to the question, am I going to look for shorts in topics? No, the answer is no. If anything, I look for longs. It is moving sideways also, and at the lower edge of the sideways range, look for long, not look for short. China market, CSI 300 index. Let's see what is the answer there. China market is not going anywhere. It is inside a range created by watermark resistance, trendline resistance, watermark support, trendline support, and the range is there in weekly also. Very much sideways movement. If anything, Friday's candle is bullish. Not only in shape, it has bullish flow also. Price is at pendulum low in daily. So the answer to the question, am I going to short now, is a clear no. Am I going to buy? No. I'm not going to buy also because it is having many trendline resistances, but certainly I'm not going to short as well. Sideways move. 3 out of 3 global markets are in sideways move now, and none of them are in a position that I'm going to short. What about UK's FTSE index? 4 out of 4. Sideways move right in the middle of the sideways range, that is a no trading area. So the answer to the question, am I going to short now? No, we don't short near the middle of a sideways range. We short at the upper edge. By the way, that upper edge short when the bear release came would be a very profitable short as well. But now there is no Q guideline to short. I'll not buy also. There is a trend line resistance nearby, multiple of them, but I will not short as well. It's also moving sideways. Let's look at India's Nifty 50 last, NSEI. India used to be the strongest of the global markets, and the weekly is still in an uptrend. It still has higher low, higher high. However, daily is in a downtrend. It has lower high, lower low. Am I going to short? The answer will be, using Q guideline, no, because though it is in a downtrend, it is too close to the lower boundary. In a downtrend, too close to lower boundary, the reward risk ratio will not be attractive enough, so we will not short. Am I going to buy? No. Friday's candle is bearish in shape. Weekly backdrop color is bearish. I'm not going to buy, but I'll not short as well. So the answer to the question, am I going to short any of the global markets? The answer is no for all of them. Out of these markets, only India market is in a downtrend using daily interval. All the others in a sideways move. Now, if we look back, remember when the bearish headwind appeared, right at that time I suggested caution, and in my own account I traded several bearish trades. Stocks don't allow shorting in India, so I took them using either options or futures, and most of them I closed with profit. As of Friday's close, I am not holding any of those bearish options or futures trades. Am I holding any bullish trade, or did I at least suggest any potential buying opportunity in India? Let's see if it is there in the forum sagarnandi.com. I shared this post 4 days ago, 29th November. That was a post on how to find a dividend play and buy it at the low end in any country. This analysis was on the India market, but the Q techniques and systems are applicable to any country, any market in the world, so long as we are trading liquid markets. And I am not sharing these posts as trading tips, but explaining a robust trading technique. So it is relevant to everybody, even if we are not trading in the India market. Now I shared this company Bpcl as a buying opportunity, and let me go through a bit detail on why I did so. The market was still coming down. If we see the chart again for the market as a whole, Nifty 50 index, the daily was in a downtrend. Then I looked for a stock that is safer. What is safer? In a business that is going to be in vogue for a long time. And the industry for this stock Bpcl is oil and gas refining in marketing, which will be in vogue, which will not be a stock like Doku, for example, in USA, which may be in favor sometimes during COVID crisis, which may not be in favor when COVID crisis is gone. It seems like that. But oil and gas refining and marketing is going to be in demand for a long time in India. Another reason I thought it was safer is because it was paying a dividend of 8.9%. Also, using seasonality, I looked at the long-term performance. I looked at the stock's performance for last 20 years, and I saw for 81% of those 20 years the stock went up. That is expected. India's economy is growing, population growth is still there, and this is in oil and gas refining marketing. The revenue and business is going up, and the stock went up 81% of the last 20 years. And on the day I shared the idea, 100% of PR stocks were up, while the market was still in a downtrend. The industry was not amongst the strongest industries, but it was accelerating. Let's now look at the snapshots that I shared using live market on that day. The industry score, relative score, and this is using QH for the Indian market. QH, like the other Q systems, can be used in any country, any market. So this is QH for India market, looking at industries from the India market perspective. The oil and gas refining and marketing was not the strongest. If it was strong, then the real-time score, relative score, would have been cyan. It was not strongest, but it was improving, and that acceleration was shown in the pace column over 5 days. In Q guidelines, we are allowed to buy in an industry that is strong or accelerating. In this case, the industry was accelerating. Then I looked at the stock. The stock itself was up by 2.9%, robust earnings quality, reasonable earnings growth, and high revenue growth. Funds are accumulating the stock. 100% of peer stocks were up, and the dividend yield was 8.9%. So fundamentals allowed us to buy as a dividend yield play, and also it had accelerating earnings growth and reasonable revenue growth. And as I explained, looking at 20 years of history, the stock was up 81% of the time. Usually I don't look at this yearly performance, longer term performance, but the market was in a downtrend. I was buying or considering buying a dividend yield play. So in the worst case, I would have held the stock longer term. So I looked at the longer term performance of the stock. That was positive. Seasonality was neither bullish nor bearish, but longer term performance was positive. And then I looked at the technical charts. I noted that it was at jump and thrust low, which would be extreme low from where a recovery was likely, and right on that day price started to go up. In the daily, it displayed a bull release signal, that is, bulls took control from the bears. It was oversold, shown by the stretch band indicator, and now bulls took control, that gave the bull release signal. The relative performance tilted up, so the stock was doing better than the market. In this case, the market would be Nifty 50. And the stock was going up with bullish pressure as well as bullish pressure U-turn. In the weekly, it came to this congestion area price level, stopped there, displayed bullish indecision at the bottom and a bullish shape candle. Because the decline was sharp, I wouldn't expect the backdrop color to turn to bullish. Color did not turn bullish, however, the shape was bullish. Did it have any trade setup? If we consider this congestion area as a support level, and I recognize there was no watermark support, if we consider this congestion area as a support level, then we could apply the concept of the box long trade setup. In daily, we had the bull release, we had bullish pressure, heavy activity just before the reversal move at the bottom. So if weekly had a support, then we could apply the concept of box long setup. If not, we would say no, there was no Q trade setup. However, it was a dividend play in a stable industry, in a stock where fundamentals were strong and industry was showing acceleration. So I suggested this kind of buying idea in a down market. It would be a dividend play, longer term holding if required. Let's look at the stock how it did by the close of Friday. Bpcl, Bharat Petroleum. Let's look back at the post. When I shared it, it was the first yellow candle after these two large bearish candles. That is the real-time post that I shared, probably during market hours. And when I look at the live chart, it was certainly during market hours. After the two bearish candles, it did not turn yellow at the close. It still had the bullish indecision at the bottom, but on that day at the close, the candle color turned red in daily. Traffic light color turned red. It was a dividend play. I already took a long position using real-time charts. I was willing to hold it longer term if required. One day after my entry and after my posting the idea, traffic color turned neutral. Shape was still not bullish. Next day, Thursday, we had a bull release signal and the shape finally turned bullish. It also went up with bullish pressure. Friday, traffic light color turned green and we had another bullish pressure. The weekly closed with bullish indecision at the bottom. The candle shape has turned even more bullish from the first time when I shared the idea. Once again, I shared an idea, a buying idea, when market was still in a downtrend, therefore a contrarian trade idea, dividend play to be on the safe side, and that also has worked well so far. I see there is a trend line resistance nearby. If it can break out of the trend line resistance, I expect it to easily cover the reward risk ratio. In fact, even if it hits the trend line resistance, it will cover reward risk ratio. And I have this practice for swing trading that whenever I take a long trade using stocks or short trade using stocks, I place GTC order, one cancel another GTC order, two of them, one for stop, one for target. If it goes to the trend line resistance here, that initial target order will be hit, at least partial position will be exited. Now, why did I share this stock idea? As I explained, safe industry, good enough fundamentals, accelerating industry, high dividend play. Now, I also wanted to highlight that in the last webinar, I mentioned that on the market breadth studies, if the percentage of stocks at the not at the if the percentage of stocks above, let me open the chart first, not this one, India market breadth total view. I explained in the previous webinar, and I explained that while discussing the USA market, that if this percentage of stocks above 50 MA for the market breadth total view, and for India it is calculated using the two major exchanges, BSE, NSE, and three major indices, Nifty 500, Nifty 50, Sensex 30. In market total view, if this composite percentage of stocks above 50 MA comes to the red level, which is 20% level, and tilts up, then I start to look for buying opportunities. It was already below the red level, and then I don't remember if it was starting to go up, but I found a safe stock in a safe industry dividend play, and I suggested the buying idea and bought it also at the same time. So these concepts that I explain on the USA market mostly in my webinars can be applied to any market using live analysis, not after knowing the fact. So those are the reasons I suggested, and I took also a buying idea in Bpcl. Now while here, why don't I look at the USA market breadth total view first. USA marketplace total view is created from the 6 items: two composites, Nasdaq NYSE, and 4 major indices: S&P 1500, S&P 500, Nasdaq 100, Dow Jones Industrials. Here also I am looking for price to come to, price meaning percentage of stocks above 50 MA. Not price exactly, percentage of stocks above 50 MA to come to the red level, that is the 20% level, and tilt up from there. That has not happened yet. If it comes down little bit, it will hit the 20% level, and then I look to buy opportunity when the yellow line tilts up. It is approaching there. Now, when the Hindenburg signals came, I tweeted. I remember the tweet. The tweet is of course still there. I remember the tweet saying that this cluster of Hindenburg was reason enough to stop buying stocks and look for shorts. Very timely analysis. That was when the cluster came, before the drop actually happened. After that, price has dropped significantly. I also mentioned, and you know my technique, the 3-month new high-low line. Whenever it goes to the lower extreme, I start to look for buying opportunities. One reason I mentioned that I was actually starting to look for buying opportunities is that the 3-month new high low for total view came very close to the extreme level, and though on Friday the market went down, and in this case the candle chart is a custom index for total view, not any general market index, but a Q calculated custom index comprising of all these elements. Though that came down on Friday, the 3-month new high low actually tilted up. So that was another non-bearish sign that will tell me that not to short now, at least. Whether to buy or not is a different question that is to be answered based on actual stock charts, actual industry strength. But the question that will I look to short now? Looking at the yellow line, it is getting to the level where shorting is too late. Looking at the 3-month new high low, it is the time when we can start to look for buying. So these factors are contributing to my comment that I will rather look for buying now. There will be more pointers to why I said that. If you see this marketplace total view, you will notice, of course, the Hindenburg. You will notice the distribution counts. You will also notice that on Thursday it actually had an accumulation count. That is important. That is also a factor that led to my comment that why I may look for buying. Thursday we had an accumulation count. Why it is in yellow color? One accumulation count is not big enough to show it in green color. Anything above 2 is green. I think anything about 5, 6, above 4, 5 and 6 is in cyan. Yellow is not large enough number. Still it is an accumulation count, and that came from NYSE, which is a very broad index. So the Thursday's recovery is or was not negligible from NYSE, a very broad index. And Friday's custom index for total view, it actually closed above the low of Thursday, also above the low of Wednesday. So the low of Wednesday was not breached by closing price of Thursday, Friday both. That is also a non-bearish sign. Is it bullish enough? No, the candle chart is not bullish enough, but non-bearish sign is there when I am reading the chart in detail. Now the accumulation count on Thursday came from NYSE. Why don't we look at the market breadth for the two exchanges to see if we have more information from there. I already showed earlier in webinars that the Hindenburgs appeared in both NYSE on the left, Nasdaq on the right. Since then, price dropped. We have one accumulation count in NYSE on Thursday. And if you look at the NYSE candle pattern, Wednesday's low was very low, Thursday's high was much higher, Friday's close also is much higher than Wednesday's close. Nasdaq is different. Wednesday's close, Thursday's rally was muted compared to NYSE. Friday's close was lower than Wednesday's close. So Nasdaq is weaker in terms of the candle chart. And I am discussing the percentage of stocks above 50 MA in many webinars for Nasdaq NYSE, and we saw that for a long time NYSE yellow line was about 10% stronger than Nasdaq, and that strength is now very visible from the candle chart also. Earlier it was visible from the breadth study of yellow line, and now the strength is visible from the actual composite price move also. So NYSE is showing strength, and now after looking at the composites, when I said that I may look for buying opportunities, I may refine that statement to say that I may look for buying opportunities in non-technology stocks because Nasdaq is relatively weaker. Also, if we look at the 3-month new high low, we saw for total view it started to tilt up after reaching almost the lowest extreme. In NYSE, we see that it actually hit the lowest extreme, went to this lower band and then tilted up. Whereas for Nasdaq, it is at the lower extreme. I expect it to tilt up next week. The tilt up has not happened, but for NYSE, the tilting up has happened. That is another reason to look for buying opportunities, at least in non-tech stocks. More cues. I showed on the total view that if price comes to the, not price again, it is the percentage of stocks above 50 MA, the yellow line comes to the 20% level, very oversold condition, and tilts up from there, I look to buy. For NYSE, it hit the 20% and went up from there. For Nasdaq, not yet. It hit, but it's still back at the 20% level. That is also showing another reason why you and I may start to look for buying opportunities. Let me also change to the weekly interval. I shared it earlier, and let's see, looking back, how the analysis came handy. When the advanced decline and the percentage of stocks above MS studies, they both, as well as up-down volume, they were showing bearish divergence. Before price came down, I mentioned that it was time to be cautious because this happens every time. The weakness always, probably not even required to say almost always, the weakness is always shown in the advanced decline and up-down volume bearish divergence first, always, not even almost always. And remember, these studies in Q market breadth, they are not using any average calculation for advanced decline up down volume new high low. Advanced decline is the study where the bearish divergence has most sensitivity and next up down volume. They are most relevant. The bearish divergence, and that is to be studied on the longer term weekly interval, not daily interval, that came very handy once again along with the Hindenburg signals. Price came and now NYSE has reasons to look for buy setups. That is why I made that comment. There are reasons for that comment from market, ETF study or future study as well. Let's look at that now. Let's continue with Q Global. I could use Q Elite, but let's continue with Q Global. QQQ. We saw Nasdaq is relatively weaker and QQQ is also looking weak. In the daily, it is coming down, has trend line resistance. There is a trend line support. Therefore, it is not in a downtrend, you may say. Looking at the trend line resistance and support, it is inside a range. For very short term purposes, it is in a downtrend, but it has trend line support. So we may be more correct in saying it is inside a range, not in a downtrend. It is some distance away from the trend line support both in daily, weekly. So the weakness we saw in Nasdaq, that may lead to a further drop. This is one place where I will not buy and I may not mind shorting, not using daily interval because it is significantly below the swing high where it created a false upside breakout where it displayed a bearish headwind. It is already some distance away from the swing low. So using daily chart, I will not short, but using intraday chart, I may not mind shorting. Now also note at the same time that in the alternate daily chart, price is at 50-day moving average and it has a lower tail. It has a solid body, so the candle shape is indecisive, not bullish, but it did stop at the 50-day moving average. So when I looked initially in the entry chart, I thought I may not mind shorting, but after looking at the alternate chart, I'm doing live with you here, all the analysis, I may not want to short, may not buy also. But the answer to whether I'm willing to short QQQ after looking at 50-day moving average support, the answer will be no. And that answer will be even more strongly no for the other market ETFs. Let's look at S&P 500 ETF SPY. It is right at weekly trendline support. Wednesday's close was right at the bottom. Thursday had a bullish move with bull release, with bullish pressure, with bullish U-turn. Friday close, indecisive shape, but well above Wednesday's close. In the alternate chart, I see this also closed just at the 50-day moving average. And the trend lines are very important in Q technique, trend lines and these watermark pivot levels, because they have zero lag. The trend line in weekly will tell me that I am never going to short SPY on Friday's close. By the way, looking back, I just noticed that the bullish headwinds once again caught the very bottom. The bearish headwinds caught the very top. Two more reasons why we Q traders pay attention to the bearish headwind signals. They came before the uptrend and downtrend respectively. Now SPY, the answer is clear. I am not going to short. And I want to go back to QQQ. I missed one signal. No, I did not miss any signal on QQQ. Okay, let's look at dia. Yes, on dia I see this. I was remembering that some of the market ETFs were at jump and thrust low. No, it was not QQQ, it was dia. Dia came to jump and thrust low when it became magenta in both of them. That is extreme oversold and the recovery was likely. Wednesday, it went below the 200-day moving average, closed right at the bottom. I think that is when jump and thrust both turned magenta. Thursday, much better close, went back above 200-day moving average. Friday is actually having the most bullish candle in dia compared to SPY, QQQ, dia. Out of these three, dia is the most bullish candle. Still indecisive, has solid body, lower tail, but most bullish among the three market ETFs we studied so far. In the Q entry chart, we have a bull release on Thursday, bullish indecision on Friday, bullish pressure, bullish U-turn on Thursday. Came to near trend line support in daily and weekly. So the answer to the question, am I going to short? No. It is right near trend line support in weekly, daily both, several bullish signals, extreme oversold condition. In fact, it had also 3-month big move up. That is a bullish signal. Most of the time from there price recovers, most of the time, especially if it is at pendulum low. It is not at pendulum low, so I am hesitating to be more bullish. If it was at pendulum low, I would be more bullish. At the same time, it is not at pendulum low, but it is at jump and thrust low, so it is likely that price will recover. Do we have a bullish setup in dia? No, we don't have a bullish setup in dia using Q guidelines. Neither do we have a bullish setup in SPY, QQQ. So I may not want to buy any of these market ETFs, but look to buy stronger fundamental stocks. Just like I selected Bpcl in India market, there may be bullish stocks fundamentally, technically, industry wise in USA market as well. We'll look at that if we have time, but let's look at the market in more detail. I always put more emphasis, or I should say most emphasis, on the market level, then industry level, then stock level. And when market had a sharp down move like this, it is even more important to look at the market to decide if it is time yet to look for buying. So far the answer is it is not time to look for shorting. That is clear. Whether time to buy, we'll have to figure that out. Let's look at small cap ETF IWM. Here in the weekly, the trend line is broken, so that is bearish. However, it is very close to the watermark support. What is the trend in the weekly chart? It was for a long time, in fact almost from the beginning of the year, from February onward, it was inside a box. Momentarily it broke out of the watermark resistance, and I mentioned I was not going to buy at that time in live webinar before knowing the result, because there was a bearish headwind at the same level. So I was expecting a false upside breakout, and I mentioned all this publicly before knowing the result. The false breakout happened and it fell down most heavily. And I remember using Q global market breadth also, right when the small cap versus large cap was starting to roll over, I suggested caution at that time that probably coincided with this false upside breakout. From there it came down. I anticipated and it came true. Now it is near watermark support. So that is too late to short. If we look at the entry daily chart, again Wednesday's close was very bearish below this deep watermark level. It's a deep watermark level. Thursday's close very bullish with a bull release signal. Not only that, with bullish pressure U-turn. However, Friday dropped again but closed above the low of Wednesday. Not as strong as Dia, but it still closed above Wednesday's close, and it is also above the watermark level. So the watermark support in daily, a deep watermark, those are more significant, that held. Another thing here also, like Dia, it did hit low jump and thrust both. That is extreme oversold condition, and a recovery from there is likely. It is not at pendulum low, but it did reach low jump and thrust, and it did give biggest up move of 3 months. Those are bullish signals enough not to short, and it is oversold conditions also not to short now. The statement I made not to short but to look for buy had reasons from other market studies as well using Q systems, and let's look at them. Let's look at technical breadth using Q finder, balance between bulls and bears. Let's look at the daily picture first. That is bearish. Whether we look at all signals, 70% bearish, strength signals 66%, trend continuation 67%, reversal even more bearish 86%. Nowhere it is bullish. Friday was bearish in terms of technical breadth. What is this technical breadth? We finally make money buying a stock only if it goes up using stocks or ETFs. We make money shorting a stock ETF only if goes down. Therefore, we want to align our trades not only with fundamentals, industry, market forces, but also with the overall technical breadth calculated across thousands of stocks. And that breadth calculated on liquid low price, not low, calculated on liquid stocks except the low price stocks which are more speculative. Friday's breadth is bearish. However, if we look at the weekly picture, all signals, this is weekly picture, all signals bearish, strength signal very bearish 90%, trend continuation very bearish more than 80%, 84%, but reversals are bullish. And the actual number of reversals is not insignificant compared to gap downs, which is a kind of strength signal. So this number of bullish reversals is showing that there may be stocks in oversold condition that are fundamentally strong that we may buy. We may buy oversold stocks at support using one of the reversal setups. These are bullish reversals. These bullish reversal setups could be headwind or box or bounce, or we could use even trend line touching to anticipate a bullish move from there, or we may use a reversal candle to anticipate a bullish move from there. The actual trade will be taken using the daily interval for swing trading, but the number of bullish reversals, percentage of that, is telling that it may be okay to look for buy setups. Not only that, let's look at Q edge now. Today I am looking at the market in a different order. This is Q edge, one page, home page snapshot. Friday's sector industry stock advance decline breadth was bearish. No question about that. The red colors immediately show that. At the same time, the percentage of stocks in the lowermost bucket, in the bucket analysis, that shows where the S&P 1500 stocks are relative to the Bollinger Band. This percentage of stocks in the lowest bucket hit 50% during market hours, one of these days, recent days, probably Wednesday or maybe Tuesday, I don't remember. I tweeted about it during live hours. So it hit 50% level, but where is it now? Only 6%, 6.3. So percentage of stocks below lower Bollinger Band hit 50% level, and now they came down to 6%. How can that happen? That can happen only if those oversold stocks went up. How much did they go up? They at least went above lower Bollinger Band. Did they go above mid Bollinger Band? No, because the percentage of stocks above mid Bollinger Band is still only 15%. Majority, 85%, are still below mid Bollinger Band. So they recovered from lower Bollinger Band and closed somewhere below mid Bollinger Band. What kind of trade setup could we look for such a movement from oversold condition? Why oversold? Again, from here also, hitting 50% in the lowest bucket is oversold. Hitting more than 80% below mid Bollinger Band is oversold. So we could look for buy setup. What kind of buy setup could that be? It could be bullish headwind setup that is more attractive when it appears below lower Bollinger Band. It could also be bounce setup or box setup if we had trendline support or watermark support at those oversold levels. So there was reason to look for buying oversold stocks which became less oversold. They are still oversold in aggregate but became less oversold. That is also one reason this being less oversold since Wednesday is a reason to look for buy. And there is more reason as well. Let's look at the very useful 1 month to 1 day sector industry stock advance decline breadth. 1 month, 10 day, 5 day, very bearish. Friday is also very bearish. But notice the 2 day period, that is consisting of Thursday, Friday performance both. That is very bullish. So even though Friday had a drop, that was nowhere enough, nowhere close to being enough to reverse the bullishness of Thursday. Thursday was so bullish compared to Friday that 2 day period is strongly bullish. 91% of all sectors are up, 90% of industries are up, 81%. 81% is very high level at the stock, the granular level. So that is a reason to think that if next week market starts to go up, we'll have an opportunity to buy the dip. 2 day period bullish, 1 day period bearish. Now if it goes up, Friday will create the dip and Monday will be buy the dip opportunity. So that is yet another reason that we may look for buy setups. Let's go back to market breadth. Let's look at how the mega caps are doing. Mega cap top 20 custom index. It came down after reaching the upper boundary. So you wouldn't buy at upper boundary. This is mega cap top 20 custom index. From the high it came down. And now it is near the trend line support Friday's candle shape is indecisive. So if I ask the question, am I going to short now for mega cap? No. Yes, mega caps were very weak recently relative to the market. We can know that from the relative performance tilting down. In aggregate, mega caps were weak, but it is also near trend line support with an indecisive shape candle on Friday. Am I going to short now? Answer will be no. What about market leaders index? I put it together using the stocks Dr. Jeffrey Scott identified during his virtual stock meet, USA Leader Index. It in fact broke down. It had a trendline support here earlier. On Wednesday, it broke below the trendline support. Thursday did not recover. Unlike some of the market ETFs, Thursday did not recover, didn't have a bullish shape candle. Friday fell further. However, Friday also closed at the yellow direction line, which may act as support. So am I going to buy now? No. But the answer to the question, am I going to short now, will also be no, for two reasons. One is it is at yellow direction line, and also it is some distance away from the recent high. Stop would be very far, so I will not short. Those are the reasons I mentioned that I may not want to short now, certainly not short, but look for buying opportunities. What kind of stocks to buy? I will not have time to look at new stocks. What you may look for, as I explained in my recent masterclass on scanning, look for stocks at, let's look at the scans. We may of course use Finder, or you may use combo scans to look for stocks at memory trendline support using weekly interval. And if we find some stocks like that, then look for indecisions at low. Then we'll be able to catch stocks that are probably not up yet, but that are stalling at memory support weekly interval and more likely to go up from there. After running the scans, you may look at their fundamentals and industry strength. I don't have time for that today, but I will look at a stock I shared earlier in the forum. Again, before knowing the result, two kind of stocks to look for buying now: oversold at support, or stocks that are not oversold but that are holding up very well. And KLIC semiconductor stock is one of them. I shared it initially on November 17th on my post, but I did share before that in the weekend market recap before that. In fact, on that day, in that weekend recap, KLIC was the only buy idea I shared. This is a snapshot from that webinar. I explained that it came to the weekly trendline support. After that, backdrop color turned from bearish magenta to neutral yellow. Using live data right on that day, the backdrop in weekly turned bullish. Shape was also bullish. In daily, it went up from the white direction line, moved sideways, broke out of this trend line resistance and also next trend line resistance. It did hit low jump and thrust at the lowest extreme, so recovery was likely. And I remember I mentioned in that webinar, Friday's webinar, that you could wait for Monday, or you could in fact buy the stock on Friday itself. And I also mentioned I took a long position on Friday itself. This is what I described in the weekend market recap that time. Let's see how I followed up. The stock went up and hit the upper boundary. I had one position using long call option and earnings was nearby. And I explained in the forum post that I followed up with that because the option volatility would collapse after earnings, and in this case, which I didn't do usually, I did take a naked long call, not vertical, so I planned to exit it before earnings, and I did that with a 15% profit. Not huge profit for naked options, but I didn't want to hold it across earnings with naked call. I closed it with 15% profit. Now I did take a stock position also and entered the stock position here on Friday when I shared the idea. Put my stop using the protection level below recent low, and my initial target could be at upper boundary, but in this case using upper boundary I could not cover my risk distance, so it was not at upper boundary, it was slightly above that, using the distance where reward risk ratio would be 1. What am I doing with this stock as of today? Let's look at KLIC, and you will see the power of this 360 degrees analysis, which may be carried out in top down or bottom up, but we always end up with buying candidates in a strong market. When I identified the idea, market was bullish, strong market, bullish industry, bullish fundamental, bullish technical. I shared the idea on this day. I placed my GTC order, OTC order, one can sell other order for target and stop. Market has collapsed, and in fact semiconductor industry was one of the weakest and most decelerating recently. I shared that in a tweet that was using QH live analysis. But look at what happened to the stock. It did not drop at all. Didn't go up but didn't drop at all. So neither my stop has been hit nor my target in this case has been hit. So my GTC OTC orders are still in place. The trade is in play. Once I plan a trade, I follow the plan. I didn't exit the trade just because the market was coming down. I had a stop order in place and the stop did not hit. I'm still in the position, and this is the kind of stock you may look to buy, which did not come down in spite of the sell-off, not only in the market, in the semiconductor industry as well. Let's look at KLIC's fundamentals as of now, and I will like to look at its industry also and explain that even if the industry is weak, I had a plan with stop and target level. I followed that. I did not change the plan. Fundamentals don't change every day. After my initial post, one earnings result did come out, and I can see that even after the earnings, the stock is continuing to remain undervalued. Earnings growth is still very strong across all the 6 quarters. Revenue growth still very strong. So it is a crown jewel, undervalued with earnings growth, revenue growth, crown jewel in Q terminology. Fundamental strong, has a short squeeze potential, and we see on Friday also 81% of peer stocks were down. So in itself the industry semiconductor equipment was down. And if I look at the relative strength from QH, I'm looking that up right now. We see that both Thursday, Friday it is weak, and the pace column is showing it is sharply decelerating. We can see the deceleration from change in relative strength, relative score over multiple periods. Month 7 was the strongest, not month 7, maybe month 6 was strongest, today was weakest, one day is also pretty weak, decelerating. So the industry is weak, fundamentals are strong, but once I planned the trade, I didn't change my plan in spite of industry weakness, or certainly not in spite of market weakness. I'm letting it play out. And if this kind of stock that is holding up very well, if you don't have a long position yet, I'm not suggesting buying now, but if it breaks out of the trend line resistance, hopefully with bullish pressure or heavy bullish activity, then you may look to buy. Backdrop is bullish, but it is moving sideways. A breakout will be a buying idea, buying time. Relative performance is showing bullishness. It was at jump and thrust low and still at thrust low. That will be another reason to look for buy setup. It is also inside a squeeze. That will also be a buying opportunity if it breaks out of the squeeze, which I will expect to come with alternate momentum signals also, and probably with bullish pressure, bullish volume. You may look for that. So two kinds of stocks to look to buy. One is oversold stock at trendline support or watermark support, or with bullish headwind, the unique reversal signal, or stocks that are not oversold because they did not drop, they held to their price level with relative performance showing strength. If they break out of the range, you may look for buying those stocks also. This analysis show why I commented that I may not want to short now. I may look for buying ideas like in KLIC if it breaks out of trendline resistance. That's all the time I have for today. Thanks a lot for joining. I look forward to seeing you in my next session. The next public session will be in the next weekend market recap. Look forward to seeing you there. Have a great weekend, and no reason not to do that, as is seen from these live examples. Trade profitably. Thank you.